The big banks are in big trouble. In today's video, I'm going to show you what Dimon has done. I'm going to look at what happened in the real estate market, and I'm going to show you everything you need to know about how this relates to you, the individual, your family. Everybody is actually waiting for a moment, and I'm going to describe that in today's video. You came here for the truth, so let me unveil that for you. The stock market enters correction territory, but why has this been the case? I'm going to give you everything you need to know. Let's begin by taking a look at that. You can see the S&P 500 entering correction, the Dow, S&P, and the NASDAQ here. Of course, you generally have the NASDAQ being more volatile on the way down and the way up. It hadn't performed so well just recently, but in the lead up to it, of course, we had seen many different tech stocks doing well. The autumn pullback in the stock market worsened on Friday, pushing the S&P 500 into correction and its worst two-week decline this year. And of course, you're looking at it everywhere. The stock market is so bad. The investors are freaking out. It's one after the other after the other. And we can see that, of course, what's happening. There's more attraction right now into the bond market because of the yield. For some, we are watching this at a time in which the yields are rising quite a bit. Most people would say, I'm not going to invest in bonds. But listen, the financial companies, the big banks, they are doing that. The pensions, they are doing that. And so that takes a little bit of that attraction away from the stock market, and they can kind of balance that out. Bonds haven't been doing well because if you were holding bonds before, now the value of them had declined a lot. And so as an investor, you can simply hold until maturity, but that's what, these financial groups here, the pensions, they don't do that. They trade it. So now the value has declined. And so they are stuck holding this stuff that they don't want. They don't want that bond for 30 years when it was giving 2%. They want that to do much better because they need to pay out their investors a higher rate. And so that's what's going on right here. I think it is extremely important to understand the equities, that's the stock market, and bonds. It's a very different world. And yet the bond market, which we don't necessarily like to talk about, it's not nice, we don't have to say Apple and Amazon and all these fancy things that you see in the news with new technologies. The bond market is bigger. It's a bigger market than the stock market. So of course we got to pay attention very carefully. This is the worst October for stocks in 5 years, having investors exiting the market. Active manager poll positioning shows investors have reduced risk. And you could see that just looking at it, they have reduced. Okay, just let's be very clear. They're not running for the exits, but we have the charts, the data to show us that in fact they have reduced their positioning in equities. But it's not just about running for the hills and protecting yourself. It's also about the rate of return. What's funny about this is that bonds have been more attractive, but there's another asset that's also been more attractive. Have you been aware of what has outperformed the stock market this year? Can you guess? Well, we'll talk about that in a minute. Dimon plans to sell $141 million worth of JP Morgan shares. Now, you got to see, look, this is being the first such stock sale during his tenure. So it's not, oh yeah, you know what, they always sell some shares, no big deal. This is big. This is important. Now, who knows? Maybe he needs the cash, he needs a liquid, he needs to spend it on a new home, who knows? But it's worth noting. Because if you think about it, just like with other, Tim Cook or whoever, they get compensation in the form of shares. Now, if they would have thought that this would be worth more a year from now, wouldn't they hang on to it? Wouldn't they keep that? If it was 141 million and he thought next year that was going to be 241 million, wouldn't he just hold on to it? I think so. But I believe there might be a little bit of hesitation on his part and others as well. And so that's what I want to bring to you. It's important. It's something to note. This right here, what you're looking at, is the money mirror method. And within the money mirror method, you need to understand that what we can see is correlated. And I've talked about this before. Everybody on my Friday live sessions that we go through, it's a private live group. On the Friday session, we talk about the money mirror method, and the white line you're seeing there is the S&P 500. So when it was out of whack about 3 months ago, I told everybody in the group, this is unusual. Let's look at it. Let's track it week to week. And that's what we do. And whenever it does get out of whack, we start to ask the question, is the stock market going to come down, or are the reserves, that's where we're looking at the orange line, the reserves going to go up? And it's, it could be a bit of both. But of course, during this period, we noted specifically that the stock market had become way too overvalued, and so it needed to correct. This is a part of a healthy stock market. Now, the market is not too healthy because it's got adrenaline shots left, right, and center. But this is what we're looking at. And of course, we are able to note this. We are able to see, almost have a crystal ball, if you will, when we simply look at what has proved to be historically accurate over and over and over again. The money mirror method hasn't failed so far. Okay? It's gold. Gold officially outperformed stocks in 2023 as the October rally continues. So, you've got gold when it's touching 2,000. That's one big change, because you didn't really see that for a while, right? Gold, depending if you look at it in inflation terms, it can still, it's still got a ways to go to get back to where it was. But the part of the reason I mentioned when we look at that, and by the way, you can see the performance of gold recently just outperforming the stock market. I want to note something. If you are one of these big banks, you have a couple options. And so you can invest in bonds. If you think that maybe, stock market's not going to perform right now and I need a guaranteed rate of return, I don't want to lose money. They call it risk parity. Well, you would see that putting your money into bonds would hopefully be able to return some, a good return. On the other hand, if you thought there was turmoil, you would want gold, because the gold would be able to withstand the troubles. If there's inflation, it would be able to do well during that period. And so again, risk parity, you could balance out your risk or equities position with bonds or gold. But if you thought that, for instance, bonds were going to give you a lot of return back, you wouldn't want to invest in gold. Just be clear, this is paper gold, and we're talking about the big investors. So what has happened right now, which is interesting, is that both gold and bonds are becoming attractive to investors right here, because we've got tensions and turmoil going on in different parts of the world. But at the same time, we want that hedging risk. We're trying to get away from that. So that's what's happening with gold right now. And people are asking the question, where do we invest? What should I do? Is real estate and so on? Well, let's talk about real estate. I got some charts or articles and information for you today. Let's just touch on this though. This is showing us the deposits, okay? And again, we've had individuals pulling money out of their banks. They're worried about what's happening inside the banks, and we haven't seen this at the level. This is seasonally adjusted level. Look at it on the non-seasonally adjusted as well. Anyway, the point is, we haven't seen this level since back during March, during the bank failures. So it is relevant to what we can see right now, and it is a big concern. The banks are indeed failing. And you have to understand, if the banks are going to fail, if the government is going to pump in a bunch of cash that they need to go into these big debts that they have, massive debt, they have to essentially arrange for the Federal Reserve to come in and buy it all up. This is the biggest concern. This is the worry, that inflation will not be allowed to fall. It won't subside, and you will have a crisis like we've never seen before. Mortgage rates at 8% make a brutal U.S. housing market even worse. Just thinking about it, 8%. People have not been dealing with that for a long time. Most real estate agents that are working right now have never seen that. And so that's where we're at. The mortgage market is so bad that lenders want ex-employees to give back their bonuses. So apparently they were getting these big sign-on bonuses, and now they're saying, give me that back. We need help right now. And so we know it's bad. But it's not just in one place or the other. I mean, I'm seeing that all over. This I thought was relevant. The bubble risk all over the place. You can see where markets have declined, but that was from their crazy peaks. I think overall real estate is still way overpriced based on pretty much any metric you use, but this is on a global scale and you can compare that for yourself. Dubai, obviously, outperforming basically everything, and yet, even if you want to call it a bubble in a sense, there's just so much money flowing in. It's just unbelievable. If you want to know about that money mirror method, if you want to get in on the Friday class, you can do that at the link in the description where it says mentorship. Okay. At the same time, if you want to be able to get information that you don't find it on the Bloombergs and everywhere else, then Seeking Alpha has that. I partner with Seeking Alpha to be able to get an extra layer of depth. So if you're interested in that, I got the free trial. Just take the free trial at the very least. The link will be in the description so you can check that out for yourself. Okay, definitely take a look around. Just see it for yourself. Then don't think about the stuff you see online, the free Seeking Alpha stuff. That is not anything close to the paid stuff. And basically, what we need to understand for the most part is that people are not willing to accept the fact that maybe we are in a state where banks will fail, that mortgages will remain high, and that inflation will not come down because of one reason or another. And so we got to live in that world and do our best. And so that means reducing our expenses as best we can. That means getting out of any bad debt that we have. That means if you can, get a side hustle going, start to pay down any debts, start to save that money in what you believe is the appropriate vehicle for that. People who are holding on to gold right now, doing well. But what is your exit strategy if you have any? I know people that want to buy in and sell at the right moment. That might be with paper gold, right? If they're doing that. At the same time, if you want to be able to, actually keep up with inflation, well, you've got to have some level of income coming through. Is that from bonds? Is it from dividends and stocks? You got to understand, okay? Look at your financials right now and be honest with yourself, okay? I hope you appreciated this information. If you did, hit that thumbs up button. When you do, it supports the channel. I really thank you for doing so. I thank everybody that's, helps me out on Patreon, everybody that helps me out through PayPal. I don't thank you enough, but I want to just extend that thank you to you. Everybody who supports me in any way. Thank you very much. I'll see you on the next one. Take care.